Thank you very much. I always have to start my presentation with making the lawyers happy, so some disclosures right up front to put everybody to sleep. But while you're reading through those, I'll let you know. TIAA Bank is a division of TIAA. Most of you probably know it as TIAA CREF. Turned 100 years last year, and as part of the rebrand effort, they dropped the CREF from TIAA. So we are a division of TIAA, founded 100 years ago by Andrew Carnegie to take care of teachers' retirements. We now have over $1 trillion in assets under management, and TIAA came and purchased the bank that I worked for a couple years ago, so now we're part of the great division of TIAA. They also own Nuveen Investment Management, so Nuveen is a division of TIAA also. So we've got a really broad base of investment options for all of investors, including what we bring to the table at the bank is great rates on checking, money market, home loans, and then my division offers investments in precious metals and foreign currency. I always start off my presentation with a look at the global economy. So as you can see, the global economy is dominated by really three different areas. They make up about 60% of the overall global economy, and that's the U.S., the European Union, and China. Those three control the global economy, and obviously what happens between those economies is really what determines how the rest of the global economy performs. The European Union, of course, is in a state of flux right now with the Brexit, and several changes in leadership, including a change in leadership at the ECB, the European Central Bank. China, as we know, is embroiled in a trade war with the U.S. right now, and they've lost some of their growth. They've slowed down because of that trade spat and have slowed growth. They've also starting to change their economy. What we've seen is the Chinese economy has evolved from a manufacturing-based economy to more of a consumer economy, which is actually good for the rest of the globe because China is now starting to consume some of those products made in the rest of the world instead of just pushing their manufactured goods onto the rest of the globe. Japan's been stuck in a stagnant economy for the past, we call it the lost decades in Japan. Their economy has not grown in spite of the fact that the Japanese central bank has tried to stimulate their economy. They dropped interest rates to negative interest rates. They've purchased their bond. They've gone and started purchasing and making big purchases in the equity markets, all trying to stimulate more spending in Japan. But demographics are really working against them with an aging population and very high savings rates. It's all this stimulus has not yet worked. Because of that, it's allowed India, one of the faster growing economies, to start catching up to Japan. And Brazil, another emerging market, is also starting to catch up to and inserting itself as a more major part of the global economy. Brexit, I just mentioned that. That's supposed to occur October 31st. We'll see. Boris Johnson, the UK Prime Minister, certainly wanted it to occur on October 31st, but now it looks like they may kick the can down the road again a little bit. But if and when, and I think it will eventually happen, that takes the UK out of the EU, and as you can see, it actually increases the importance of China within the global economy. China, it will be and is the second largest economy as far as a single country economy, and is expected to surpass the U.S. in the next decade. So China is very important. On the U.S., the state of the U.S. economy, we believe the U.S. economy is doing better than most people are leading on, I think. We are leading the developed world out of the Great Recession. Interest rates, the Fed has reversed course and has started to pull back on interest rates. They've made 2 cuts now. Some think they'll make another cut before the end of the year. I'm leaning towards they're going to leave them right where they are. The tax cuts are still filtering through and generating more spending by businesses and consumers. The growth is steady. It is slowing, but we were surprised by the robustness of the growth figures that we've just got out. The U.S. economy is not slowing nearly as quickly as some had predicted. Debt and deficits certainly continue to grow, not so much on the consumer side, but certainly on the government side. The government continues to grow debt and deficits. In this low-rate environment right now, they're easily able to cover that interest payment, but there is some worries about what happens when interest rates begin to rise. And finally, trade wars. Trade wars really have no winners. I know that we're working for a better solution to the Chinese trade problems, but it is pushing down growth both in the U.S. and China, and could lead to currency wars where the currencies are also getting pushed down. U.S. consumers are in great shape. I won't spend a lot of time on this chart, but the green line is net worth of U.S. consumers. As you can see, it's reached record levels with the equity markets reaching new highs and housing prices staying up. The U.S. investment portfolios are at all-time highs. At the same time, the savings rate has recovered. So this puts the U.S. in a better position to handle any downturn that might occur. Inflation's still not a problem. This is the Fed's preferred inflation gauge, PCE. And as you can see, it's stayed well below the 2%. The red dotted line is the 2% goal of the Fed. And so far, they've been able to maintain inflation just below that. In fact, they would like to see a little more inflation. Most of them would like to see inflation get above that 2% target. But right now, it's slightly below. But the yield curve, so everything looks great except the bond market. The yield curve, this is a picture of the slope of the yield curve. It's the 10-year minus the 2-year. So in a normally economic environment, you have a positively sloped yield curve because of the time value of money and risk. You expect to have a higher rate of return on a 10-year, higher yield on a 10-year than on the 2-year bond. So that would be a normally sloped yield curve. What we've seen is the yield curve has flattened dramatically. And in fact, it's kind of hard to see on this, but there's shaded areas right after each of those arrows. And those are recessions. So over the past 5 recessions, the yield curve has inverted on an average of 13 to 14 months prior to the recession. Sometimes it's 2 years, sometimes it can be as short as a couple months. But typically, the yield curve inversion has preceded a recession. So that's, as you can see, the yield curve this part of the yield curve has just inverted in August. It inverted again in September. So that's flashing some warning signals about the U.S. economy and had a lot of people worrying about an imminent recession. I don't think it's right around the corner, but it certainly has a lot of people worried about it. Volatility has also returned. As you can see by this chart, normal measure of volatility, the VIX, we're seeing a lot more volatility in the markets, and we do expect that to continue. The interest rate and trade wars. So this is a chart of the S&P 500. And what I've done here is put every interest rate move are the arrows. If the Fed raises rates, I put a red up arrow. And when they cut them, I put a green down arrow. I didn't include the latest cut. But as you can see, the market pretty much shrugged off all these higher interest rates up until the last two. In the last 2 interest rate increases, market participants were starting to feel that maybe the Fed was going a little too far and getting too far ahead of the curve. At the same time, you've had what's driven the markets even more than the Fed, in our opinion, is the trade war. And so I pointed out different points of the trade war. And as you can see, as the tariffs have been placed onto the goods, we've seen that really impact the markets even more than the interest rates. But with the Fed cutting twice now, we're back, that reversed those last two cuts that really had everybody turning against, and really fear increased in the market. So now I think we're at a fairly good neutral place on interest rates, and I think the Fed's going to just wait and see what happens with the trade war, what happens with the global economy, and make sure that the U.S. economy continues to grow. The global economy is really supported by extremely low yields. There's now over $15 trillion worth of global debt that are yielding negative yields. And that's something that is really hard to comprehend for most people, and myself included. Typically when you borrow money, you expect to pay interest back. The person lending you that money is expecting to get paid for while you use that their money. Right now, that's flipped, and we see a lot of 25%, in fact, of all global debt is now has yields below zero. So you've got investors buying bonds and expecting, in fact, guaranteeing that they're going to get less back if they hold them to maturity. Now, of course, most of those investors aren't going to hold those bonds to maturity, and in fact, it's kind of the greater fool theory, if you will, that they're expecting someone to come and pay even more for those bonds down the road before they mature. So they're expecting this low rate environment to continue, and so that's one of the reasons we see the rates dropping as they have. German 30-year debt went negative last month. I put last week. That was a month ago. So, and there's actually a Danish bank that's now offering a negative interest rate mortgage. So it's just mind-blowing to me that you're able to buy a home, get a home loan on a home, and actually make money on the mortgage, which is just crazy. So, the results of this negative interest rate environment are we've never been through this, so it's really increasing a lot of the volatility in the markets, and it's increasing a lot of the uncertainty around where the markets are headed. The U.S. dollar has certainly been supported by these global yields because U.S. actually is trading at a premium. Yields in the U.S. are typically trading higher than the yields across most of the developed countries. So that has supported the U.S. dollar. It's made the dollar stronger. It's also allowed alternative assets, those assets that either are not interest rate sensitive or precious metals is a good example, a non-interest bearing asset. It makes them more attractive for investors because the opportunity cost of owning that precious metal, not earning interest, is actually easier to justify in a low or negative interest rate environment. An end to the strong dollar policy. Our president certainly wants to see an end to the strong dollar policy. President Trump has made it known that he would like to see the Fed lower interest rates aggressively and would like to see the dollar weakened. He believes that would help the trade situation, and it would certainly make our goods cheaper overseas. And he believes a lot of our trading partners are using lower yields and driving their currency down in order to get an unfair advantage in the trade wars. And certainly the dollar has not been, while we're in this little period of dollar strength, in fact it's been about an 8-year period of dollar strength, if you look at the 30-year chart of the dollar, it's actually decreased. This is the chart of the dollar index. And as you can see, we've consistently over the last 30 years hit lower highs and lower lows. So we've been in a downturn. However, within that downturn, there's been 3 times of dollar strength, and we're still in a period of dollar strength, and then followed by 2 periods of dollar weakness. You can see at the end of that chart, the dollar peaked out at the end of 2017 our 2016, 2017, we started moving it down. Last year in 2018, we saw the dollar reverse course and start heading back up. There's really a question whether or not we're at an inflection point. If in fact we're going to see this dollar start weakening trend again and move lower. Gold has certainly broken out. This is a chart of gold, and as you can see, it moved through the $1,400 level recently, and as we crossed that level, it didn't spend much time at all at $1,400. It moved right up to $1,500 and is now trading right around $1,500 per ounce. A couple things have driven this. Obviously, the lower interest rates have made gold more attractive to investors. At the same time, investors, it's a safe haven investment. And as we've seen more volatility, as we've seen more geopolitical concerns, we've seen investors moving back into precious metals as a way to secure a portion of their assets in a hard asset, in an investment that they know will have long-term value. So we've seen more investors moving back into the precious metals. Gold has certainly been undervalued. It's been beat down and held down for a number of years, and so it was good to see it break above that important $1,400 level, and in fact went right up to $1,500. This is a former Fed chairman, Alan Greenspan, not necessarily known as a big gold bug, but you know, before he was chairman of the Federal Reserve, he did have some writings about the advantages of holding gold. And here he was talking just earlier this month in an interview about the reasons he sees why investors are moving into precious metals. And it's really about the fact that they want to have something, a hard asset in their portfolio so that, you know, they know that there have some value no matter what happens to the markets with all the volatility, that they're able to expand their portfolio and diversify into hard assets. So where do we think you can find value in this year? First of all, we think the U.S. equities are going to continue to maintain value. We think you know, it'll be tough to surpass the highs of 2018, but we do think they'll have some value. We, of course, focus a lot of our attention on international debt and international markets, the equities. Lower U.S. rate expectations and a weaker dollar could eventually benefit emerging markets. We think there's some select emerging market economies. India is one of them that we think hold real value. I'll dig deeper into each of these different markets during my breakout session tomorrow. So I'd encourage you, if you want to hear more about our opinions and see actual investment suggestions, I'll be digging in then. Currencies, with the strong dollar policy being forced away, we think there's ideas on currencies, and then of course the precious metals. My time is up, so I'll skip through these. Again, I appreciate the opportunity to speak to everyone, and I will be holding a more in-depth session tomorrow at 10:45. So I encourage you to come by and see us at my workshop or on the floor. Thank you very much.